If you've been keeping an eye on Apple stock recently, you might be wondering why it took a slight dip of 0.5%. Well, it turns out that Warren Buffett's Berkshire Hathaway has decided to trim its flagship position in the tech giant. The company sold approximately 1.09% of its Apple shares, which translates to a staggering 10 million shares. This transaction alone is valued at around $1.8 billion. Sure, Buffett still has a hefty 5.9% stake in the iPhone maker worth about $167 billion. However, this move still came as a surprise since Buffett praised Apple at Berkshire's annual meeting last year and even went as far as to say that Apple was a better business than any they owned. Also, in the same meeting, he admitted that an earlier cut to Berkshire's Apple holdings was a mistake. So what pushed Berkshire Hathaway to pare its stake in Apple now? In this video, we're going to delve into 3 possibilities that might have triggered Buffett's change of heart. And that's not all. We'll also uncover the surprising stocks that Buffett has been buying instead. So don't miss out. Welcome back to PST Markets. If you've been following Berkshire Hathaway for a while, then maybe this sale isn't that much of a surprise to you. This is because the Apple position held by the famed investors company has grown to an outsized share of around 50% of its more than $350 billion stock portfolio. As Apple shares were pushed higher and higher by the tailwinds of the tech industry, many investors who follow Berkshire have wondered how much bigger Buffett and his deputies would allow the position to grow. Berkshire also sold 32%, or around 30 million shares, of its stake in media company Paramount Global and 78% of its share in printer and PC maker HP. So some expected the Apple sale, but what drove Berkshire to sell now? There are a couple of ways you could explain this, and the first one is that Berkshire simply thinks that Apple's valuation is just too high and provides an opportunity to take profits. Apple's shares currently trade at 28 times expected earnings, compared to the sector median of 22.27. That wouldn't be a ridiculously high forward earnings multiple if the company were delivering stellar growth, but Apple isn't doing that right now. In fact, when looking at Apple's 2024 Q1 results, which ended on the 30th of December in 2023, you'd see that the company reported year-over-year revenue growth of just 2%. Apple will likely continue to grow, but there's no compelling reason to expect Apple to return to strong growth anytime soon. In fact, the stock hasn't kept pace with those of some of its big tech peers in recent months, and Apple even lost its crown as the US's most valuable company to Microsoft earlier this year. The company faces weakness and declining sales in the Chinese market, which accounts for 20% of Apple's revenues. In January, it even had to offer discounts on its newest iPhone models in China. This came in the midst of strong competition from local smartphone manufacturers in China, like Huawei and Xiaomi, and after China ordered government officials to stop using Apple's devices at work and stop bringing them into offices as a response to the sanctions the US imposes on China to restrict its access to the most advanced semiconductor technology. The company is betting that it can reinvigorate growth with its upcoming VR/AR headset, the Vision Pro, which is undoubtedly an impressive piece of technology. Still, it looks like a solution in search of a problem rather than a must-have gadget. The problem with the headset is its staggering price tag of $3,500, which would likely result in lower demand, especially when you compare it to Meta's Quest headset, which can cost you anywhere from $400 to $3,500, depending on its specifications. Moreover, buying a $3,500 headset isn't the same as buying a $1,000 phone that you use every day, and that should go without saying. Another possibility behind the sale is that Buffett could want to land an elephant, which is his term for making a big acquisition. While Berkshire has around $157 billion in cash, he could still want to keep some extra money if the stock market plunges, creating many great buying opportunities. It could also be that Apple has grown too much in Berkshire's portfolio. At around 50%, it's not strange that Buffett would want to unload some Apple shares for redistribution, diversification, and to buy opportunities somewhere else. This leads us to our next point, the companies in which Berkshire Hathaway increased its shares. In the same period of the Apple sale, Berkshire added to its stakes in Chevron and Occidental Petroleum, both oil and gas companies. 2023 has been challenging for the oil and gas sector overall, thanks to the fluctuating prices that came with the economic slowdown in China, the world's largest oil importer, geopolitical tensions in the Middle East, and many countries following contractionary monetary policies that impacted global growth. But 2024 could be a good year for oil and gas stocks, since global central banks will probably turn to pursuing expansionary policies, like how the Federal Reserve is expected to decrease interest rates in the US, which could translate into a higher demand for oil and global GDP growth acceleration. There's also the fact that OPEC and allies have been proactive in supporting oil prices through production cuts, which could be why Buffett is currently buying so many oil and gas stocks. In just the first 5 days of February, Berkshire bought 4.31 million shares of Occidental stock in 3 transactions, totaling $245 million. This raised its stake in Occidental to 28%, meaning that it's now the company's largest shareholder. Occidental is also emerging as a strong player in the carbon capture space, which is expected to grow at a 24% CAGR to $12.9 billion by 2030. The company is building a direct air capture facility in Texas that is expected to be the largest DAC facility in the world, with a capacity to capture 500,000 tons of atmospheric CO2 per year when commercial operations begin in mid-2025. Buffett has also praised the company's CEO, Vicky Holub, calling her an extraordinary manager of Occidental during Berkshire's annual meeting in May of 2023. As for Chevron, the company is the 5th largest holding in Berkshire Hathaway's stock portfolio, and it saw better than expected fourth-quarter results. It appears that Chevron stock could be on track to close the performance gap with the sector ETF, the Energy Select Sector SPDR Fund ETF. The company also forecasts 2024 production to be higher again by 4% to 7% as it increases its investments in renewable energy and carbon capture. Additionally, analysts expect Chevron stock to deliver total returns of 20% to 30% in 2024 if oil trends higher. The company also has a healthy balance sheet and operating cash flow potential of more than $40 billion. This allows Chevron to sustain great dividends that yield 4.33% and have a 5-year growth rate of 6.25%, as well as make aggressive investments in exploration activities and big acquisitions. For example, in October 2023, the company announced the acquisition of the energy company Hess Corporation for a massive $53 billion. For the current year, Chevron has a massive capital investment target of $16 billion. Once Hess Corporation is acquired, the annual capital expense budget is expected to be between $19 billion and $22 billion, allowing the company to support long-term cash flow upside. So both Occidental and Chevron look like good stocks to own as we get further into 2024. Still, while many investors study Berkshire's filings for a read on how Buffett and his investing deputies may have been thinking about the market, it doesn't mean that you should blindly invest in these stocks. In other words, it's important to do your own due diligence and understand that all stocks are affected by some kind of risk, especially oil stocks, which face a lot of volatility thanks to geopolitical tensions and other industry-specific factors. And suppose you own Apple stock and are wondering whether it's a sell now. In that case, it's important for you to know that Berkshire's decision alone isn't enough to make an investment decision regarding Apple stock, especially since it's still the company's largest holding. Additionally, this decision might not have been Buffett's, since 10% of Berkshire's equity portfolio is overseen by managers Ted Weschler and Todd Combs. Berkshire doesn't say which managers make equity buys and sells. While Buffett oversees the huge Apple investment, he has said in the past that a small part of it was held by one of the other 2 managers. So it's difficult to say whether Buffett, Combs, or Weschler made the Apple sales in the latest quarter. Well, that is everything for now. What do you think? Will you be following Buffett's lead and buy Occidental or Chevron stock? Please let us know in the comments below. If you haven't, please subscribe and like this video. Your support helps us continue our work. Thanks again for your support, and I will see you in the next one.